Hey everyone, welcome back to Corporate Decoder. Today we're diving into something from Goldman Sachs, but I promise it's more exciting than it sounds. It involves real estate, tech, and how they manage their money. Let's see if it's a gold mine or just fool's gold. This Goldman Sachs Trust 2 report covering the last 6 months paints a picture of how several of their funds are performing, what they've been investing in, and how much it all costs. Some funds are doing well, others are facing challenges, but it's all public record. Before we jump in, if you find value in getting clear insights from these reports, smash that like button and subscribe for more deep dives. We've also got a Discord community, the link is in the description below. We're looking at the semi-annual report for several Goldman Sachs funds, including the Multi-Strategy Alternatives Fund, Multi-Manager Non-Core Fixed Income Fund, and the Multi-Manager Global Equity Fund. This report covers the period up to April 30, 2025, giving us a snapshot of recent activities and financials. Let's start with the Goldman Sachs Multi-Manager Global Equity Fund. Total net advisory fees paid hit $2.4 million. It's also worth looking into a quick overview of what this specific fund invested in. Sector allocation shows where the fund's money is spread out. Information technology taking up 17.1%, followed by financials at 16.3% and industrials at 10.7%. That said, nearly 12% is distributed to a variety of different sectors. The key fund statistics also tell a story with about $1.5 billion in total net assets being managed. With 80/43 portfolio holdings, it's diversified. Its portfolio turnover rate sitting at 37% suggests an active management style. The cost for an R6 class investment of $10,000 runs about $23 or 0.46 catted there. Other funds though, so let's change gears fast. Moving to the Goldman Sachs Multi-Manager Real Assets Strategy Fund, we have about $2.2 million in fees paid. The sector allocation here is very different, focused on real estate at 56.9%, a high 17.7% in utilities, and 13.2% in energy. This fund manages smaller assets, $817 million compared to the previous one. The portfolio turnover rate is 36%, slightly less active than the Global Equity Fund. The cost to invest here is about $33 per 10,000, a slightly higher 0.66%. We'll get back to the different fund performance as the end. Sector allocation features a big concentration in industrials with 21.5% and financials with 20.8%. And Third and information technology also have a sizable number of investments with 14.8% and 13.6% respectively. This fund is the smallest of the funds we looked at so far, just over $500 million in total net assets being managed. Its portfolio turnover rate sits at 47%. The fees are also higher at $35 for every $10,000 invested, which is 0.73%. Now we turn towards the alternatives fund, which is structured very differently. The Goldman Sachs Multi-Strategy Alternatives Fund Class A shows total net advisory fees paid at nearly $200,000. What's interesting here is the reported asset class exposure. It's completely different than the other sectors. We have 32.4% in cash, 81.2% in commodities, plus exposures to developed markets, currency, fixed income, and even short-term investments. The numbers are also broken down into gross, long, short, and net. The note that all these statistics are tied into derivatives and not traditional assets. Worth keeping in mind, however, the total net assets of this fund is far smaller, a little over $58 million. This fund is very lightly traded as the portfolio turnover rate is reported at 0 SASTED. The other classes, CP Institutional and Investor, also show similarly structured holdings. The cost percentage is at least double the other funds though, sitting at 0.7% for Class P or as high as 1.76% for Class C. Finally, let's cover the bonds and note sectors. The Goldman Sachs Multi-Manager Non-Core Fixed Income Fund R6 report shows just over $3 million in advisory fee payments. The sector allocation shows a strong focus on sovereign debt obligations with 37.9%, indicating investment in government-backed securities. Then distant readings of software 4.5, parents and insurance 3.7, engine and oilfield services, media and commercial services. Total net assets of this fund sits at nearly $1.5 billion and includes close to 1,300 portfolio holdings. It's also worth noting the top few costs of a $10,000 investment for R6 class is at around $27 a year, which is equal to 0.53%. Lastly, there's the Multi-Manager International Equity Fund Class P, which has a cost of $26. The biggest sectors they invest, it seems, are financials at about 20% and industrials at another 20%. Information technology and consumer discretionary are distant third and fourth with 12.6% and 11.2%. At $1.5 billion total and a 24% portfolio turnover, this appears to be among the most conservative but highest grossing funds. Now, moving away from all the numbers, what's also included in these filling is a standard code of ethics, their financial experts and other compliance related data. Michael Latham is determined to be the audit committee financial expert and is independent utterly now. Let's step back and ask what this all means. Each of these multi-manager funds has clearly defined strategies and target assets and is working to minimize all those fees. For some of these funds, it's important to make sure you buy the right class with lower fees, while for the multi-strategy alternatives there may be better opportunity alternative. There may be better opportunities elsewhere given the small number of assets managed and the high costs. These multi-segment funds don't appear to be very focused on anything concrete and in some cases even list some of their biggest assets as null or having a value of zero. Many of these funds are heavily reliant on derivatives. This increases complexity and risks that you might be better off avoiding given the funds haven't been performing particularly well as of late. The global and equity focused funds look the more promising of them all and appear to be taking a fairly conservative approach with a high distribution of investments of relatively equal percentages. Alright, that's our breakdown of this Goldman Sachs SEC filing. What's your take? Are these guys playing it smart or missing some golden opportunities? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and remember to subscribe and check out the Discord in the description. Thanks for watching. See you next time.